Hello, everyone, and welcome to Vancity Investment Management's 2024 Portfolio Manager Outlook slide. My name is Jeffrey Adams. I'm the Chief Investment Strategist with Vancity Investment Management and a Director in Vancity Sustainable Wealth Management Division. Today, I'd like to acknowledge that we're joining you from the unceded territory of the Musqueam, Squamish, and Tsleil-Waututh First Nations, who have been custodians of this land for thousands of years. I would like to pay my respects to elders, both past and present. Today, you'll be hearing from three of our esteemed investment professionals. Mark Sheard, who leads our equities portfolio management team, Wes Dearborn, who's a portfolio manager on our fixed income team, and Kelly Hirsch, who is our head of ESG analysis. So without further ado, I will pass it off to our host, Rakesh Mehta, who is an investment counselor portfolio manager with VCIM, and get on with the presentation. Thank you for joining us today.
Thank you, Jeff, and good afternoon to all of you joining us on the call from home. As Jeff mentioned, I am one of the portfolio managers here at Vancity Investment Management, and I'm looking forward to being your moderator for today's session. 2023 was another interesting year, to say the least, and as we quickly begin 2024, I think it will be another year of challenges and opportunities as we attempt to navigate the financial markets. I know you hear from your dedicated portfolio managers often, but we thought it was really important for you to hear from some of the other members of our investment management team that work tirelessly behind the scenes for you. I think you'll really enjoy our speakers today, as they're all experts in their respective fields and very engaging. After the presentation period, we hope to have a short question and answer period, so please place your questions in the chat box within the meeting window. If your question goes unanswered, please forward it to your VCIM representative, who will be happy to provide an answer for you. If you have to leave the webinar prior to its conclusion, rest assured we will be emailing out a recording of the full webinar in the coming days. Without further ado, I would like to pass it over to Mark Sheard, who is our lead portfolio manager on the equities team. Over to you, Mark.
Yeah, thanks, Rakesh. And hello to everyone on the call today. So as Jeff said, my name is Mark Sheard, and I run the equity portfolios here at Vancity. And my goal today, along with my colleagues, of course, is to give you a high-level overview of what has been happening in the markets, our thoughts around this year, of course, why we are very optimistic and why you should be. And most importantly, as we constantly say at VCIM, why it is time in the market as opposed to timing the market that matters. But before I get started, I want to say that each of us understand the responsibility that we've been given in terms of ensuring we get the best possible returns that we can for each of you, and we take it very seriously. We're also personally invested in the funds, and we have friends and family that have also invested, so we're all very well aligned. So starting off, I just want to touch on the highlights of last year, in order to give some context around what we were expecting for this year. So we can just move to the first slide. If we go back in time to about 1 year before from today, the wall of worry was, kind of a mile high entering 2023. And at the top of the list of fears, of course, was a recession, which was probably the most anticipated and expected recession in history. But the myriad of other concerns included rising inflation and interest rates, which were expected to keep, consumer spending down. And of course, one other thing which I didn't list here, but there was the ongoing war in Ukraine. So entering 2023, we had this constant flow of negative headlines, which was creating a lot of angst amongst investors. And on top of this, stocks had just suffered their worst year since 2008, and bonds had their, worst year on record. As you can see on this next slide, which is showing the returns of the S&P on the left hand, followed by a 60-40 portfolio, and on the right, the US 10-year bond index. So not only did the S&P fall by more than 18%, but bonds, which many investors look to for balance in their portfolios, weren't far behind, as you can see on the right. So the very well-known and followed 60-40 portfolio, which consists of 60% equities and 40% bonds, had its most difficult year on record. I mean, I don't know how many news stories I saw talking about the death of the 60-40 portfolio, which with the power of hindsight, we now know was way off the mark. Though this doesn't really surprise me. You don't really get, viewers' attention with stories of optimism. But I should also point out that investors on average, we have very short-term memories. What has been happening recently tends to be what we focus on going forward, and we extend that into the future. So when you exit such a difficult year as 2022, I think most investors, they're going to have difficulty believing that the markets are going to turn in their favor, and it's because of this, along with our, I guess you could call them natural instincts to avoid loss at any cost. I mean, at any cost, many sell at the bottom and buy at the top, and constantly get in the way of that, wonderful compounding machine that we call the equity market. Just moving on to the next slide. At the same time, we had this constant headline negative news. What we were focused on internally and expressing externally was that we were already past the point of, I guess you could call it maximum damage. As you can see in this chart, which shows the year-over-year growth of inflation, like we'd already seen a steady decline over the past several months, which was leading to a decline in interest rate hikes. And as we've said many times, I mean, the equity market, it's anticipatory. It doesn't need inflation to get back to 2% or interest rates to fall. By that time, it's already moved on and you've missed the subsequent rise, which is why it's so futile and downright impossible, in my opinion, to try and predict the timing of such events. I mean, all you have to do is look back a few years to when COVID reared its ugly head and we were all stuck indoors. I mean, the initial belief was that it would take years for a vaccine to be produced. But as we now know, the market jumped on the initial news of a potential vaccine and moved straight up and to the right. I mean, it really was a spectacular rebound, and only those who stayed invested, were able to reap the benefits. On top of this, as we can see on the next slide, historically, the market has rebounded quite nicely after down markets. What this table is showing is the returns of the S&P since 1970, after the market has fallen by up to 20%. And on a 3, 6, 9, and 12-month period, I mean, the results are very strong. At the risk of repeating myself, the natural pull for the market, it's up and to the right. Down markets are less common than up, and years like 2022 are even less common. The probabilities are in our favor. We just have to, make sure we play our hand. And just moving on to the next slide, last year, it gave us some excellent market returns. I mean, S&P was up by over 24%, MSCI World by almost 22%. The TSX did lag by quite a bit, but that's coming off a very strong relative performance the year prior due to a surge in energy names. And as we all know, investment returns are anything but linear. And we witnessed that in pretty dramatic fashion actually at the end of the year, as November and December of last year is going to go down as one of the strongest back-to-back months for financial markets in history. The S&P's, I think it was almost 14% gain over those 2 months. That was in the 99th percentile. And for reasons that I just touched on, according to most economists and market strategists, last year was supposed to be a tough year. However, consumers, they shrugged off inflation, higher interest rates, and investors, they were just more optimistic than fearful, partially due to exuberance around AI that I'll touch on in a second. And achieve this high return in spite of the fact that there was a drawdown during the year of over 10%, it proving once again, that risk, it's not an impediment to reward, but the underlying reason for it. And if we just quickly look at sector returns on the next slide, although every sector was in positive territory, tech stocks led the market higher at over 50%, which was its biggest gain since 1999, followed closely by communication services, which holds tech-like names such as Alphabet, better known as Google to most of us, and Facebook, or as it's now known, Meta. And as I touched on earlier, AI was at least partially responsible for some of this tech performance, which really moved into the mainstream after Microsoft launched its ChatGPT model early in the year. And I don't want to linger on this slide, but just one other thing I want to point out is how the sector returns are almost a complete reversal of the prior year, when energy was by far the leading sector and tech was the laggard. I mean, it just goes to show you how quickly sentiment can change and how, we as investors can take advantage. I mean, if you want to make outsized returns, you have to be willing to look in areas where the clouds are the darkest, as once the pendulum swings back, it often swings back quite violently, which is exactly what we saw last year. And this next slide is a very good visualization of what was a big driver of returns last year, dubbed the Magnificent Seven. These 7 companies on the left of the slide were amongst the best performers, and due to this, along with their size, they drove a large portion of market returns. So just to put it in context, Apple was the laggard of the group with a return of 49%. And just to contrast this, a record 72% of stocks underperformed the S&P last year. So now collectively, these 7 companies account for about 17% of the all-country world index, which includes emerging markets, and is more than the combined weight of the UK, China, France, and Japan, which is just incredible. Again, this is something that I think most investors would have scoffed at the beginning of the year. So turning to the next slide, last year's stock market returns were quite strong, even looking back over history, as you can see in this table. You know, like a bell curve, majority of returns fall near the middle, but last year was in the top 20%. And when you look back, I think over the last 100 plus years. So again, not to belabor the point, but even when considering all the potential issues coming into the year, the US market gave us one of its strongest performances ever. And I think the quote on the bottom of this slide is a great summary of the year, as consensus expectations were so off the mark. It was just unbelievable. And you can really see it on this next slide, which shows all the major Wall Street Bank 2023 price targets for the S&P versus the actual year end at the far right in blue. You know, the actual price gain at the S&P at about 24% was over 18% higher than the average forecast. I mean, all in all, it was a triumph of the optimist once more. And again, it just highlights how difficult it is to forecast the short term. And although it's now easy to look back at last year as another exceptional return year for investors, it wasn't without its hiccups, which, to be honest, is kind of like every other year. But last year's hiccup was definitely a big one, as we saw 3 of the 4 largest bank failures in the US of all time, as you can see on this next slide. Before March 2023, it had been quite a while since we'd heard anything about bank failures, and for good reason. There were exactly 0 failures in either 2021 or 22, and only a few small ones in the 5 years before that. It started in, I think around March with Silicon Valley Bank, and after the market gave up nearly all of its gains on the year, it would hit bottom the very next day. And from that point on, it wouldn't really, ever look back. But if someone had told you at the beginning of the year that the total assets of failed banks last year would exceed 2008's record total by almost $200 billion, I mean, you probably would have assumed, and rightly so, that it would have been an absolute disastrous year for markets. But it was anything but. So where does this leave us as we look forward to this year? Well, as you can see in the next charts, we're quite happy to see a continuation in the decline of the inflation growth rates. At the same time, the consumer has continued to spend. Unemployment rates remain extremely healthy. So just again, the numbers, they're continuing to move in the right direction, which is an extremely positive sign. And most importantly, as you can see in the next slide, we have now seen 4 interest rate pauses from the Bank of Canada, including one from earlier this week, which isn't in the chart, and 3 from the US Federal Reserve, with expectations for rate cuts at some point this year, as I'm sure Wes will touch on in a bit. Again, these are all very positive data points for equity markets. However, like every other year, of course, we also expect volatility. What the next slide is showing is the monthly price returns of the S&P going back to 1958. And as I'm sure each of you can see, it's a very noisy looking chart, as month to month is always a guessing game in equity markets. But what you can't see is that in this chart is the gradual climb, again, up and to the right, which we have seen over and over in the markets. But it's not linear. The market is not a Ponzi scheme. Everyone should expect volatility, and instead of trying to run from it, it's best to simply ignore it. Or if you're in the position to do so, obviously take advantage of it. And if you are ever unsure, I hope that this final slide for me gives you some confidence. And what it's showing is the percent of periods that US stocks earned a positive return. As you can see on the far left, on a 1-day period, the probability, it's about 52%, which is still slightly in our favor. But as you move to the right and expand your time horizon, the probabilities skew extensively in one direction. Casinos have gotten rich off of much worse odds. Now, all we need to do is ignore the noise and let the power of compounding do its thing. And with that, I want to thank everybody for joining us, and I'll pass it back to Rakesh.
Thank you, Mark. I love the reference to the Magnificent Seven. For those of us movie buffs, I wonder if Steve McQueen is Apple or Microsoft in your example there. Next, I'm going to ask Wes Dearborn to take the reins. Wes is one of our two portfolio managers on the fixed income team. Wes, fixed income, often considered the defensive part of the portfolio, has had its own volatility for the better part of the last 2 years. Would love to hear your thoughts on this segment of the investment world.
Thanks, Rakesh. Yes, good afternoon, everybody. On that note, I'm happy to report that 2023 was a positive year, rebounding from, as Mark so politely described, as a challenging 2022. And generally, the themes that we saw in 2022 played out in 2023 as well, with inflation and central banks kind of being the primary drivers of one, volatility, but two, returns that we saw at the end of the year. Mark touched on a few points, but inflation, if you think back to 2022, inflation, was running hot. It was very topical. A lot of concerns out there, and inflation in some global economies spiked to over double digits, particularly in Europe. And in Canada, the US is up 8 and 9%. Fast forward to this year, as Mark showed on one of his slides, global inflation, including Canada and the US, has come down more into a more reasonable 3 to 5% area. So central banks that had responded aggressively in 2022 with rate hikes, last year was turned out to be more of a series of fine-tuning their rate hikes, with most major central banks enacting 2 to 3 quarter point hikes as opposed to multiple percentage points that we saw previous year. So inflation slowing, still moving higher, but slowing back to kind of that normal area where we're used to, and central banks kind of taking their foot off the gas pedal and possibly alluding to potential easing this year and beyond, turned out positively for bonds, with global bond yields generally declining in most major markets. In addition, the positive risk environment that Mark just talked about parlayed into the Canadian market as well, with credit spreads tightening in the corporate bond space back to the tightest levels that we've seen since the beginning of 2022. So all that combined resulted in the Canadian bond universe, which is typically made up of all of the government bonds issued in Canada, as well as all the investment grade corporate bonds. And the overall Canadian bond universe is kind of the benchmark in Canada and has an average maturity around 9 years. And it returned 6.7% over 2023. In terms of the makeup of that return, it was longer dated bonds that outperformed. Longer dated bonds have a higher sensitivity to interest rates through a higher duration. So when rates are declining, they typically outperform shorter dated bonds. And my next slide here will just show the breakdown of the components of the universe. And as you can see, I mentioned that corporate bonds saw spreads tightening, and typically corporate bonds also have a higher yield than government bonds. So the combination of the higher yield carry as well as tightening credit spreads led corporate bonds to outperform in the Canadian bond market. Now, the next page here, I just have another inflation chart. Actually, this one is the Bank of Canada policy rate. So the Bank of Canada increased its policy rate to 5% last year, so raising it from 4.25% at the end of 2022 to 5%. So that was done in a series of 3 25-point rate hikes in January, June, and July. And then kind of the second half of the year, the Bank of Canada was on pause. And that kind of ties in with inflation declining from those highs that we saw in 2022 and started off the year 2023 high as well. And as that subsided, the bank got more comfortable that inflation was trending back towards its 2% target. And it was able to take its foot off the gas pedal in terms of further hikes. And the bank is comfortable with where it is. It's hopeful that it's done enough. However, it does continue to reiterate that if inflation, does for whatever reason spike higher from here, they will have to respond with additional rate hikes. Next page here should show inflation in Canada, and you can see where it spiked to in 2022. So we hit a high of 8.1%, and that's come down to kind of mid threes as of the end of the year. The Bank of Canada has a target range of 1 to 3%, with ultimately 2% being the objective. So it's coming down towards that target range, but still sits slightly above that. So the bank's hopeful that it will continue to slow down into that target range. And just in terms of the breakdown of inflation, as I mentioned, inflation, this 3.4% is rising prices in and above what we saw, the prior year. So prices are still going up, just at a slower pace. One item within the CPI basket that did decline was energy prices, and notably gasoline prices were down year over year. And this is just on the back of declining oil prices from those highs that we saw the prior year. Now, there are a couple items that continue to worry the Bank of Canada and continue to trend at a much higher pace than historically has been the case. Food prices is one, and wage gains is another. And those two are both trending right around the 5% level, which is much higher than the bank would want to see. And the other component is shelter costs, and this includes rising mortgage interest costs, as well as the cost of rent, which I'm sure everybody's read and is aware of, has hit all-time highs in Canada and other markets as well. And skipping it to the next page. So in terms of bond yields in Canada, the Government of Canada bonds and bond yields are kind of the benchmark yields that we look at. They have bonds, issued across the curve, so bonds outstanding all the way out beyond 30 years. But this chart here basically shows the difference from the end of 2022, which is the lighter colored dotted line above, and then the end of 2023 is the solid green line. You can see that yields moved lower over the year. Now, this chart doesn't show the exact magnitude, but if you look at the bottom, the bar chart, it shows you in terms of basis points what the move was. And generally, the move across the curve was on average 20 basis points or 0.2% lower. So it moved down, but not significantly so. One of the things that stands out on this chart is that the yield curve in Canada remains to be inverted. And what that means is that shorter dated bond yields are higher than longer dated bond yields. And in a normal environment, in a normal sloping curve, this is not the case. Typically, longer dated bond yields offer a higher yield to compensate investors for that longer horizon than shorter dated yields. But what we're seeing now is because the Bank of Canada policy rate is still held at 5%, shorter dated bonds are very highly correlated to the Bank of Canada policy rate. So you can see the 1 and 2 year rates particularly are still elevated up near this Bank of Canada policy rate. And what will ultimately re-steepen this curve is ultimately the Bank of Canada will likely lower their policy rate, and then you will see the shorter dated bond yields also decline with that. We do know, what the Bank of Canada has told us is that, their model suggests their long run neutral policy rate is 2.5%. So as inflation declines, towards their 2% target, and right now their projections suggest this is going to happen, it's going to progress through this year and through 2025. So next year, back towards that 2% target. And as that happens, the Bank of Canada will gradually lower its policy rate from this current 5% level back towards that 2.5% kind of magic level that they perceive, which balances, the growth of the economy with keeping inflation at 2%. So skipping ahead to the next page here. So where are we? Well, bond yields have come off the highs that we saw last year, but they still remain elevated. So this chart is kind of the all-in bond yields on the overall Canadian bond universe. And you still see it's north of 4% still. And, it's come off those highs, but if you look back, it's still very high relative to anything that we've seen, kind of from 2011 to 2021, significantly higher than, the pandemic lows when Bank of Canada and the other central banks took their policy rates all the way down to zero once again. So on an absolute yield basis, we feel that yields are still attractive and offer a good approximate for returns going forward. In addition to this, the active management that we do on the funds should add value as well in and above the yields carry. And actively, we're constantly looking for opportunities, along the yield curve within sectors and then across individual bonds within the Canadian marketplace. And then, as I talked about, the Bank of Canada potentially lowering its policy rate, potentially this year, definitely in the years ahead, back towards a 2.5% neutral rate. Bonds offer the opportunity for additional capital gains. The price sensitivity of bonds is such that longer dated bonds will respond with higher price moves to further rate declines. So as we see that play out in the Canadian bond market, we will see additional capital gains in and above the yield carry and active management value add over that period. So we are positive on bonds going forward from here, and look forward to continuing to actively add value to the funds that we manage on your behalf. And with that, I'll pass it back to Rakesh.
Thank you, Wes. I really appreciate those thoughts. We'll come back to you during our fireside questions as I have a few other questions for you. One of the unique aspects of VCIM is that we've always been a pioneer in the area of using environmental, social, and governance criteria to help us formulate our investment decisions. One of the principles behind this work is Kelly Hirsch, who leads our ESG team. Knowing Kelly for the better part of the past decade, I know how passionate she is in ensuring that the companies we invest in are also good corporate citizens. Kelly, over to you.
Thanks, Rakesh. Happy to be here to talk a little bit about developments in ESG in the past year, and looking forward, sort of what we're expecting, and some updates on some shareholder engagement work that we're undertaking in relation to some of these really potentially challenging times in ESG that we've had in the past few years. So on the first slide here, I want to touch on that. I mean, it's been a very much along the lines of what you've heard from Mark and Wes on some of the challenges. ESG, a lot of this does transition is definitely you see that turbulence across ESG issues. So I mean, I think a lot of people here on the call are, obviously very aware of climate change. And I think it's really important, though, 2023 was quite we were seeing the anomalies, sort of going with that. So we saw, in Canada, some of the, biggest fires that we've had in years, and, and not just in the areas that we traditionally think of, out here in BC, but really across the country. And this was actually reflected as well, some of this if you look on the little chart here, it actually goes back. So it's global surface air temperature anomalies going back to 1940. And if you look actually at that line there on 2023, especially starting in about sort of the midpoint of the year, it is significantly higher than any other year compared to, sort of going that far back. So definitely we're seeing sort of basically climate change in action there. So definitely concerning, but I will be talking a bit about why I actually am hopeful on this. But I mean, other issues that we've had, escalating global unrest, and not just, I think, we often sort of hear with Ukraine and Russia and the Gaza war. There's also it's not just sort of these headline areas. We're actually seeing a study was put out this year where they've actually recorded 183 regional and local conflicts as well, which is the highest number in 3 decades. So definitely challenging times, and a lot, actually, some of the disruptions from climate change, some of the other areas, a lot of these really tie into each other. And I think it's important to mention too, some of the political backlash that ESG has faced, particularly in the US, in red leaning states. It's definitely changed. It's changed some of the conversations. It's made, it's led to a more challenging environment, to talk to companies, especially if we're looking at shareholder proposals, where we've seen a heightened increase of what we would call anti-ESG proposals, where, sort of a group, generally a very, right-wing leaning group in the US may file a proposal basically asking a company not to do ESG, or there are different forms that can take. We've definitely seen an increase in those. And then I won't reiterate too much, but inflationary pressures have definitely over the past couple of years produced a challenging environment for leading, to the increasing cost of capital, which when we're looking at, particularly with the energy transition and, the action that we need to take on climate change, there's a lot of capital that, is required when, let's say you're building out a, renewable energy project. And those increasing costs, they are, it can be challenging to get some of those projects that we really need to see happening now going ahead. And so we've seen some delays, et cetera, in the past year on some on that. And a lot of this also ties into the continuation of really some of the supply chain challenges that we saw in, I'd say, the pandemic. Really, there's that destabilizing effect there where we had this destabilization of supply and demand and some of the ability to move goods around. And that has, while some of those initial shocks have subsided, we've seen additional issues such as climate, leading to water shortages in the Panama Canal, which is, limiting the amount of traffic that can move through there, as well as, the global unrest, as I'm sure you've probably seen recently in the news with a lot of ships having to actually be diverted, and they can't go through sort of the Suez Canal and kind of the shorter routes. And it actually can take over 10 days extra, which, as you can imagine, that adds a lot of costs, complexity, delays, et cetera, to company supply chains. So it's been obviously it's been a challenging 2023, but I think looking forward, there's a lot of reasons to be positive. On the next slide here, we really think that, so while yes, 2023 was, the hottest year on record, we're seeing a lot of, the impacts of climate change. At the same time, we are seeing positive movement. If you look at, the COP28, which is the large UN climate, gathering of countries where they sort of come together and hash out details on sort of how, coordinated global action to achieving, the climate, carbon emission reductions that we need. Notable, I know sometimes there is, especially, where it was held in, oil-rich country, there was a lot of negative headlines you may have seen in the news, but there were actually a lot of positive developments that I think there didn't get enough publicity that I think is really important to remember that, we're seeing positive momentum. One, there was a loss and damage fund was, actually finally hashed out some of those details, and there were some commitments to, of resources of, developed, like, wealthy nations to help, nations most impacted by climate change. And then we've also seen, I think particularly notably, were the agreements on methane reductions. methane's a very important greenhouse gas to reduce now because it has like an outsized impact compared to carbon, carbon emissions contribute to greenhouse gas warming, so does methane, but at a much higher rate. So a smaller amount of methane is particularly problematic in the short term. And so we've actually had the US and China both agreed to this and are coming up with plans to see methane levels reduced by 30% from 2022 levels by 2030. Or sorry, 2020 levels by 2030. So a very positive development for some of the short-term reductions that we need to see. And then on sort of despite a lot of the ESG backlash that we're hearing and sort of seeing these increasing, so there were 68 anti-ESG proposals last year, they're not actually getting that much support. So we actually, on average, those anti-ESG proposals received less than 3% support from shareholders, meaning that these can't even be filed again because there wasn't enough investor support to bring them forward. And honestly, in our conversations, a lot of businesses, they may be toning down the language of ESG to, sort of to stay out of the politics of it. But when you're talking, these are business imperatives where, to address carbon emissions, to improve diversity in workforces, to have better governance practices in place. So this is something we're not seeing. I think it's important to watch it, but honestly, the more I'm seeing this play out, the more I see a lot of this ESG backlash. It's just noise. It's based on a very limited understanding. And if anything, I think it's actually will be helpful for the industry to really help push it forward in quantification, making sure things are quantified, making sure that, sort of when people say they're undertaking ESG actions, that they actually, that these are credible actions actually happen, being undertaken. And then on inflation, as I won't go into a lot of detail here because I know it's been covered a lot by Mark and Wes, but inflation is starting to slow and stabilize, which is helping, helps give more certainty to be able to undertake, for renewable energy development, as well as for, cost of living concerns and sort of the challenges that a lot of companies and their workforces are facing, which I'll be touching on some engagements that we're doing on that after. And I think technology, getting into supply chain management, is becoming more complicated, but at the same time, there's also more tools to be able for companies to identify, track the movement of goods, to identify where there may be challenges moving things. And so, we're really looking at investing in this type, in companies that have extensive and long-standing, supply chain management, honestly, for ESG issues, because that often translates into their ability to, sort of manage overall movement of their supply chains and knowing where goods are coming from and having those deep relationships with suppliers to ensure that they can better manage some of these disruptions. So I'm going to click on the next slide. Just so on climate is something, as Vancity, we've been at VCIM, we've been very focused on this for a number of years. And I just want to, sort of emphasize, I just talk a little bit about, some of so both on the investment side, I think it's important. Often people think of, sort of it's just renewable energy companies. Whereas this is something we're really looking for the opportunity in. It's not just going to be in renewable energy. There's a lot of other actions that need to be undertaken. So for instance, sort of we're invested in companies that are driving the energy transition, such as, Air Products, which are making some of the largest investments in developing green hydrogen, which is going to be a key source of energy for certain very hard to decarbonize sectors. Particularly in like industrials, and as well, sort of Northland Power kind of more on the traditional renewable side, in a lot of wind farms and renewable energy, and then as well, I think a couple I want to highlight: Train Technologies, and a lot of heating and cooling solutions, and we've been actually we've done a lot of engagement with them through our involvement in Climate Action 100. and have seen a lot. They're really pivotal in lowering the energy intensity and the climate impacts of heating and cooling systems that are really vital to being able to thrive, especially in a changing climate. And Xylem, I think water management that's a key piece whenever we're looking at climate. Water management is a lot of the impacts of climate will be felt through water. So I think this is somewhere where we have been looking for a lot of opportunities, to really, to invest in companies that are helping improve water management, whether that be the management of waste or, reductions in, reductions in water use through like water efficiency. And then on the engagement side, so we have this year we do continue to engage with companies in high emissions sectors on the needs on like specific improvements they can make to their climate transition plans. But we're also a big focus area for us is the Canadian banks and their their financing and how they're going to transition their investments to meet their net zero commitments. And so we have filed climate resolutions with RBC, TD, and Scotiabank, and we are in discussions on that, really looking at the impacts of how they're working with their clients to help their clients decarbonize. And then on the next, moving on to sort of supply chains and two really key areas for supply chains. And supply chain management would be biodiversity and human rights. Biodiversity being the really, I say it's what rounds out the climate picture. So carbon emissions, climate, very important, but there's a lot of other. If we just solve that, we're not solving humans' impacts, and the sustainability of our of business that relies. Biodiversity really helps touch on the impacts of pollution and land degradation and use. And so it's been, we're expecting to see a lot going forward since the recently published Task Force for Nature-Related Financial Disclosures, looking to see more companies provide more information and more reporting on how they're how they're impacted by biodiversity challenges and what they're doing to improve their operations. And on human rights due diligence legislation, so this is basically governments asking, requiring companies to provide information on how they're ensuring what steps they're taking to prevent forced labor from occurring in their supply chains. And so we've seen, Europe and the US has different legislation on this. In Canada, actually recently, it was recently enacted a bill, so it's S2111. And it requires large companies. So for instance, if they have more than 250 employees as one metric, there's some revenue metrics as well, that they need to disclose what they are undertaking, what sort of supply chain audits they have in place, and sort of best practices to address, to ensure that they don't have forced labor in their supply chains. And so some of our engagement on that topic, just on the next slide, is so human rights and supply chains has been a focus area for a number of years, and we do continue. So that's something where right now we're focusing on. We've identified sort of three sectors that we see some of the biggest risks right now, being in apparel, solar. This is largely because of polysilicon, which is a key component, and 45% of it comes from a region in China that there's some particularly concerning issues with forced labor. So that's why we've identified solar as a key area. Technology as well ties into some of those metals and minerals. And so we do continue to engage companies, and some examples of this, companies that we have ongoing dialogues with would be Lululemon, Cisco, and then Boralex, which is a renewable energy company with solar exposure. And then on biodiversity, you may have seen in I highly recommend taking a look at our shareholder engagement report if you haven't. And so we engaged Costco on this and had some very positive results where they're piling an analysis and will be publishing results next year of it. And we're building a momentum on with this engagement with and currently talking to Starbucks about biodiversity, specifically in coffee supply chains, especially with the changing climate. There's a lot of concerns about with basically coffee growing regions and sort of some of the threats that they face. So that's something you'll look forward to seeing in a few months, a bit more information on how that engagement has been going. And then finally, just quickly touching on, while inflation is we are seeing it stabilize. There are we've seen lots of unrest with labor. You've probably seen with United Auto Workers strikes, Hollywood strikes is two high-profile examples of this. But this is something where given the increases in cost of living, and sort of ensuring that workers, sort of the average worker is able to, that companies are managing that side. We see it as a combination, of human capital management and ensuring that, the benefits that a company accrues are going to their entire workforce. So upcoming engagements, some of these are ongoing and some are being expanded this year, include we are engaging with Living Wage with Amazon on asking them to become a certified living wage employer, as well as a company in our global small cap 5 below. And then we are also continuing our engagement with the Canadian banks, requesting that they start disclosing the CEO to median employee pay ratio for their operations on an annual basis, just to to ensure that we don't see sort of as gaps have been pay gaps have been widening between executives and sort of rank and file workers. We want to ensure that companies are tracking that. And lastly, an area that we've previously engaged with some other companies on, but we have as we've been sort of looking at this, we've identified actually both Canadian Railways, CN and CP, as having some gaps in their paid sick leave policies. So basically, their Canadian workers are covered, but we've identified that there's a lack of coverage in a lot of their U.S. operations. And we think, and this is potentially leading to they are having some issues with employees engagement there. So that's another area that we are engaging on this year on this area. So yeah, that's just a little brief overview on kind of looking back at 2023, sort of what has happened in what we expect to happen in 2024, and a little sneak peek on some of the ongoing engagements that we really expect to pick up steam in 2024. And I'll pass that back to Rakesh.
Thank you, Kelly. Thank you for that overview, and everyone for their insights into the environment we experienced in 2023 and some of your thoughts moving forward. I'd like to transition now, just some questions that have come up with our members. Maybe what I'll ask is for our 3 speakers to turn on their screens, because I may bounce around a little bit here. My first question, Mark, is going to be over to you. You mentioned that in 2023, a lot of investors were essentially wrong on what they thought the market was going to prevail. And I look at some of the names that sometimes are in our portfolio, and we do our research. We think we're on the right side of things. And then for whatever reason, we're wrong for a little bit. I look at Aritzia as an example. I know the women in my life enjoy their shopping experience there, but it was under pressure for a long period of time. But lately it's bouncing right back up, and I'm sure there's a few other names in our portfolio that are like that. Can you discuss, like, in general, what do you look for when you're looking at these types of opportunities, and then when you're facing those challenges and have to stick with those convictions, what plays into that in terms of you sticking with a company like that?
Yeah, that's a good question, Rack. So you're right, Aritzia, which is in our Canadian equity fund, it's gone on quite the ride over the past year or so. A couple of years ago, it was actually our best performing stock in the fund. Last year, it was one of our worst. And so far this year, as you pointed out, it's actually been one of our best. And although this is perhaps more extreme than what we expect for our companies, it's actually not like that unique. For example, people love to talk about stocks like, I don't know, Apple or Amazon. and how if only they had invested 10 or 20 years ago, how much money they would have made by now. But like what they don't talk about is how many drops in the share price they would have had to endure while they held them. I remember reading, I think it was a few years ago now, about how Apple, which listed in, I think it was 1980, it was about a 200 bagger over the next 30 odd years, which is absolutely fantastic. I would sign up for that any day of the week. But during that time, an investor had to sit through a peak to trough loss of 80% twice, 80% twice over that period. And there were several other 40% drops on top of that, which don't seem that bad versus 80%. Even Berkshire Hathaway, which of course is Warren Buffett's company, was cut in half 4 times. So like this type of volatility, it's not unique. I mean, most companies are going to see a drop in their share price by a significant amount at some time. So like what's important for us to get to your question is to be able to withstand these drops and continue to hold or even increase our position, which is honestly easier said than done. A lot of emotion comes into the equation when a position falls by a large amount. So what we try to do is to ensure that like price doesn't drive the narrative, and to ensure that we have a list of key metrics or KPIs that we follow for every company, and we believe are the key drivers for each company. And of course, just to reiterate, we've said this many times, that we're looking for quality companies with great management teams, what we deem to have moats that protect themselves from competition. And we expect them to grow and improve their position over, a 5 to 10 year horizon. So as long as these metrics continue to move in the right direction, we're happy to hold the shares. It's not easy, but we will continue to hold the shares. And many times we'll see these, price drops as an opportunity, since you can now purchase shares at a better valuation. So the key for us, Rack, is to continually test our thesis and ensure that, nothing structural has happened, which is exactly what we did with Aritzia.
Awesome. Thank you, Mark. Wes, I got one for you here. The conversations that I'm having with some members right now are quite a bit more positive than what I was having in, say, September and October. And a lot of those members that, they come to us and say, I can get close to 5% in a GIC now. Why not I just sell off my holdings and go back into terms? What would you say to a member that is having those types of thoughts?
Yeah, that's a very topical question. Even personally, family members and friends over the last year and a half, as rates have moved up, I've had more GIC conversations than ever before. And you can't blame them. If you look at GIC rates now and through the year, you're seeing 4 or 5% offers out there. And if you think back to the period between 2009 and 2022, GIC rates were well below 1% for most of that period. So 4 or 5% look quite attractive. And for short-term investors with a short horizon that want a secure known rate of return, it can be a great tool for those type of investors. But for longer-term investors, there are definitely some drawbacks relative to bonds. One of the biggest ones is kind of that reinvestment risk. So after that initial term, what rate, the rate that you invest at is unknown. So for example, let's use 5% as a ballpark number. If you invest, in a GIC at 5% for the next year, over that period, you're going to get that return. But what you get beyond that is unknown. And as I talked about, through some of those slides, we expect the Bank of Canada to be lowering its policy rate at some point, towards probably the second half of this year and definitely through next year. So if that policy rate, let's see, an extreme, example, gets back to that 2.5% neutral rate that they talk about, the GIC rate that will be offered at reinvestment will be likely around that level. Whereas bonds, the yield to maturity on our 2 bond funds that we manage in-house are right around 4.5% currently. So bonds, you'll get that yield carry, but bonds also offer that potential capital gain in terms of price appreciation if yields do continue to decline from these levels. So, over that same horizon, if you do see a move like that, with rates coming down, could differ on the curve. But if you get a general broad move lower, say, 1%, our bond funds, which has a duration of 7 years, would provide an additional capital gain approximately around 7% in and above that yield. So, bonds offer that additional return potential if rates do move lower. A couple of the other drawbacks of GICs, just quickly, is liquidity. You're typically locked in for a definite term, whereas our bonds that we invest in are fully liquid. And then the taxation, I'm not going to get into it too much, but GICs are kind of the worst, or they're kind of inefficient from a tax perspective, in that income from a GIC is fully taxable at a marginal tax rate, whereas bonds have a combination of income and more favorably taxed capital gains. So hopefully that gives you some insight from our side.
Yeah, thank you, Wes. I am cognizant of time, but I do want to get to one question for Kelly very quickly here. We often talk about social responsible investing as a risk mitigation tool, i.e., we don't invest in this industry or company because of ESG concerns. And I don't know if we put enough emphasis on some of the positive influencers that we look at when we are wanting to invest in a company that is doing good things in the world. Can you give me an example of maybe one company that you feel is doing great things in our communities in the world, and in turn feel that those positive influences have the ability to lead to positive returns?
Yeah, definitely. I think, it's a very fair point. It is something we often, sort of focus on avoiding the bad, companies, and not enough about some of the positive things. So I actually think Agnico Eagle's a good company on this side, because often when people think of mining, you sort of go, oh, mining must be bad. But actually, we've seen over the years with Agnico Eagle, they have a really strong, industry leading. I haven't seen other mining peers that are quite at their level of the involvement that they have in terms of community consultations. And it's not just about, consulting with the community, it's ensuring that communities are getting the full benefits of any projects that are undertaken there. So they have a target. Anytime they open a mine, their target is to have all positions at the mine, from people working on the ground to the senior management, that are running the mine, to be from the local community. And they will, and it's not just sort of set that target and leave it. They have a lot of programs to help. So let's say they can't find someone who has, the skills for a high paying, senior management role. They have really comprehensive training programs, et cetera, to help, upskill people and ensure. And we've seen, and the benefit of a lot of this is, so, you've probably heard different, sort of in the news, different, mines getting shut down in different jurisdictions over, community concern, community unrest concerns, et cetera. With sort of Agnico Eagle's approach to community involvement, and really looking at how can we undertake this project so that it's a win-win for both. And that's something where they're less likely to have that community unrest. They're less likely to have costs associated with that, whether it be sort of different. And there can be different costs and delays of operations, as well as in certain cases mines can be shut down by government authorities. So I think that's something that's actually one. I know it's often when people think of mining, it's sort of mining bad, but I think mining's such an important. It's going to be a key piece of the energy transition when you look at how much sort of minerals we need to be able to build the wind farms that we need, the solar panels that the transmission lines. Mining's going to be a key piece of that, and I think investing in the companies that are really doing it, when you're doing mining responsibly, is profitable in the long run. And so I think that's an important, I just wanted to highlight that. I think that's a good example of that.
That's great. Thank you, Kelly. Okay, Mark, one last question for you, only because you mentioned the Magnificent Seven and how there was just this big push towards AI. You had mentioned that one of the best return years since 1999. Is this an AI bubble that we should be concerned about?
Yeah, that's a good question. So, listen, AI, as I said earlier, it definitely had a large part in the performance of the markets, and more specifically tech companies. And although my personal opinion is that this is actually a pretty big moment in our history, in the same vein as personal computers or the internet was, as a team, we're actually really cautious about who will be the eventual winners in this space. If you look back at the beginning of personal computers, for example, I mean, most companies that started out in the space back in the 70s or 80s have since gone the way of bankruptcy. For every Apple, there are 2 or 3 dozen failed companies, and that's actually true of any new industry. I mean, the same can be said for automobiles. Only a couple of companies have actually survived since the invention of the internal combustion engine, and I'm not sure even offhand if any of the original manufacturers haven't at least once entered bankruptcy. So although I do think that we're at the beginning of a major secular shift due to AI, we're a lot more cautious about our ability to actually decipher who's going to be the big winners in the space.
Excellent. And that brings us right on the dot to 1 o'clock. So I want to conclude here today's event. I'd like to reiterate that everything that has been discussed today is our attempt to offer current and accurate information about our views at Vancity Investment Management. However, every person's situation is slightly different, and this information should not be constituted as investment advice. I encourage you to speak with your dedicated portfolio manager that can consider your personal situation. And then finally, on behalf of us at VCIM, I want to thank you for the trust you have given us to be your financial partner. Thank you again to those who attended, and have a wonderful afternoon.